So you can run, but you can't hide. The US economy has managed to dodge a crash even though the rest of the world is starting to burn. But now we have a report that tells us the odds for American recession is nearly 100%. A contraction is virtually guaranteed. And if the US economy collapses, this will spread globally. There's no escaping the pain. And in our lead story today, Deutsche Bank's top minds put US recession chance near 100%. In fact, avoiding a hard landing will be historically unprecedented. According to the bank, the interest rate hikes aren't done yet, and the Fed still has at least one more hike in the cards coming for us in July, so the pain isn't over yet. They also review when the recession will start and how bad it will actually get. Now, the US economy will experience a moderate recession beginning in the final 3 months of the year, which means Q4 2023, starting in October this year. And this contraction will continue through the first 3 months of 2024. And this means a recession will only be declared well into the middle of 2024 because there's always a lag time before the GDP results are finally revealed. So by the end of the year, we might already be in a recession. And if you honestly think about it, all the signs, they are pointing towards a contraction that we increasingly can't deny. Now, there's a reason why Powell did a pause in June. They call it a hawkish pause, whatever the hell that means, right? But in reality, Powell is afraid of breaking the real economy. He knows that higher rates are going to crash the system. Now take a look at rates today. We are back to the 2007 high of 5.25% just before the housing crash in '08. We have lived through the fastest tightening cycle in modern history, except this time the economy is so levered up that the damage from higher rates could be much worse. And listen to Powell's own statement. We have raised our policy interest rate by 5 percentage points, and we have continued to reduce our security holdings at a brisk pace. We have covered a lot of ground, and the full effects of our tightening have yet to be felt. This is clear as day. Powell knows the economy is on the edge. The real effects of higher rates aren't being felt just yet. Now, if we look at the jobs number in May, US employers added 339,000 jobs. That's almost a 20% increase versus the April numbers. So by all measures, the economy should be booming, right? But what is the situation on the ground? And this is where we need to have a reality check. The inflation fight isn't over because sticky inflation is here to stay. And the longer it remains sticky, interest rates will have to go higher or even remain high. Now we are now sitting on an economic time bomb. The fuse has been lit and we are just waiting for the mushroom cloud to appear. If we look at the CPI report, inflation has fallen down from 9.1% to 4% in 12 months. But we know that number is only relevant on Mars, on Pluto, on planet Earth. The real inflation rate is much higher. Just go to the grocery store later, guys, and you know what I mean. The issue is with core inflation. That is the indicator that the Federal Reserve is really tracking. If we compare core inflation with the CPI, it's obvious that there's still a big issue. Now, since February, core inflation has only dropped by 0.2%. It is as good as nothing. And that's why the Fed likely isn't done hiking rates yet. According to Fed Governor Waller, progress on core inflation is still very slow. It is still not moving down enough. And in order to crush it, they'll have to tighten by raising rates higher. So what the Federal Reserve does in July is highly data dependent. If inflation data for June comes out hotter than expected, don't be surprised, guys, if Powell jacks rates up by another 25 basis points, maybe even 50 by the end of the year. Now, what's more clear is Powell's commitment to keeping interest rates higher for much longer. Pay attention to this because it is supremely important. Rate cuts could only come in a couple of years, and that might be in 2025 or even 2026. The pressure on the economy isn't going away. In fact, we can kiss rate cuts goodbye in 2023. Powell once again added, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is all likely to be appropriate. At the minimum, we're going to stay at 5% Fed funds all the way until December this year. Now, can the economy withstand higher rates for the next 6 months without cracking? Maybe it can, but probably not. And let me hammer the final nail in the coffin when it comes to interest rates. This is the Federal Reserve's dot plot chart. It tells us the votes of the FOMC members on where they see interest rates at for each year. In 2023, the majority of votes indicate interest rates are going to be well above 5.5%. And there's one vote that goes above 6%, which I suspect is Jerome Powell himself. And let's fast forward to 2024. interest rates might be staying above the 4% level, with a third of the votes indicating over 5%. That is 18 months of higher rates before the Fed drops it to 3% and below. And the longer rates stay high, the more liquidity will be drained away, especially from bank depositors. And this is a very bad omen for banks. Another banking collapse isn't impossible. And speaking of bank, guys, Powell has made a shocking admission that lenders are going to face more losses in commercial real estate. There are 101 things that collapse the economy. A big one is explosion of defaults in commercial real estate loans, and this is big. Just think of the environment that we are in today, especially if you're a business. Consumption is slowing down, so your revenues are taking a hit. Then you also have employees working from home. And in a Stanford study, employees are working 27% of the time at home. They can't be bothered to go to the office unless they really have to. So businesses are either scaling back on leasing office space, either they move into a smaller and cheaper office, or they just pull out completely. So if you own commercial buildings, right, you have the perfect storm coming for you. On one hand, you have fewer tenants, which means less cash flow. And on the other, you have higher interest rates, which means bigger mortgage payments to the bank. That's a double whammy. And that's why defaults on CREs have reached a 14-year high of 5.2%. Borrowers just don't have the money to pay. I sound like Dr. Doom, but this is the bleak reality of the economy. We have owners of commercial malls in San Francisco starting to default. Retailers are just not leasing space because costs are just too high. The domino effect has begun and it's going to hit the banking system sooner or later. And I want us to consider two pieces of information, and you know how severe this problem really is. In a report by Reuters, banks represent 54% of the overall 5.7 trillion of CRE loans. That's almost $3.1 trillion in exposure. But the story gets worse. According to Citi, 70% of these loans belong to the smaller regional banks. And these banks are the most vulnerable to any defaults because their balance sheets are weaker. It's a big reason why Signature Bank collapsed. And if more defaults happen, the regionals will take a bigger financial hit. And if the damage gets big enough, they could face insolvency, which might trigger, you guessed it, even more bank runs. And putting up a story from Bloomberg, a 1.5 trillion wall of debt is looming for US commercial properties. By the end of 2025, CRE owners are going to face over $1 trillion worth of refinancing. And that means rolling over their debt into a higher interest rate. And the big question is, how many borrowers will play ball and continue their interest payments, especially when valuations are expected to fall by as much as 40%. Now, if enough lenders default and stick it to the banks, we could see another implosion in the balance sheet. So the banking crisis isn't over yet. The longer Powell keeps interest rates high, the greater the chance of a CRE default tidal wave. Now, that's just the risk on commercial real estate. And let's talk about what drives the US economy, which is consumer spending. Now, in America, 70% of GDP comes from the American consumer. The rest is from government spending. So even if Congress keeps spending money like drunken sailors, if the average Joe is broke, the economy will still contract. Now, if we dig into the numbers, we can see that consumer spending intention has dropped across all categories. Total spending intentions have crashed by 15%, while discretionary has dropped by 25%. This is worse than the intention to save money. So consumers are saving less money and spending even less. They are trying to conserve their capital and cash buffers for as long as possible. So if $500 used to last a week, now it has to last a week and a half or even 2 weeks. And this isn't good news for the US economy. And this is what Deutsche Bank is really betting on. Consumers have to exhaust the last of their savings stored back in 2020. They will deplete them nearer to the year end, and things are going according to our script for our Q4 recession timeline. What the bank is saying is that consumers are going broke. The squeeze they are feeling is going to get worse as interest rates continue to stay high. Let's try to take this apart simply. In 2018, the average US household spent 73% of their income to stay afloat. Now, this is money spent on food, rent, utilities, and non-discretionary. Less than 14% goes into savings. But that was during the good old days, guys. Because inflation is still a crisis and interest rates are staying high, households are getting squeezed across their spending today. Everything across the board in spending has gone up, either due to high interest rates, inflation, or both. Now, take housing for example. It used to make up only 22% of spending, but because rents have soared, it is now 25 to 30% easily. So if the average person has to spend more, where are they going to get the balance? We know salaries haven't kept up with inflation in the real world, and people have to save less and even drain away their savings. And because they can't print money like the Federal Reserve, there's a limit to how much reserves they can drain. Sooner or later, spending is going to have to calm down. And if we look at the poorest households in America, 100% of their total income goes into spending. They don't even have a dime in savings. And this is very tragic, guys. So, obviously, the only outcome is to cut down on their consumption. There's no other way. So, it's storm after storm when you really dig into the numbers. And that's why the American consumer today is very weak, and it's just a matter of time before all their savings are exhausted. Now, if things for you are going good, that's awesome, guys. I'm sure restaurants and boutiques where you're from are booming, but there are people on the street really suffering financially. But if you think the worst is over for the consumer, we have to brace for impact. Now, remember those federal student loans, the ones with repayments frozen since 2020? Well, that disaster is now coming home to roost. Pulling up a warning from the Wall Street Journal, student loan repayments are coming back. Retailers are in for a big shock. So all those student loan bills are going to resurface, and it's going to impact nearly 44 million borrowers of the federal government. Not only do we have high inflation and interest rates, but now a ton of money is going to be channeled away from the real economy to pay back student debt. And this is going to cause retail spending to drop by around $10 billion a month. Now, Goldman Sachs did an analysis, and it tells us how much the economy will be affected, especially if Biden's debt forgiveness plans gets rejected by the Supreme Court. And if that happens, the student loan repayments will deduct 1.2% of spending growth in September and stay above 0.5% on average till the end of the year. And this will drag down disposable income and hit retailers on Main Street. So realize the big economic storm that is coming. It's like multiple tsunamis hitting the economy one after another. There's the inflation squeeze crushing consumers, a liquidity crisis haunting the banks, and now student loan debts are coming due. Things still look good right now because monetary policy has a lag effect, right? But if Deutsche Bank is right, the economy is going to look real nasty from Q4 this year. The Federal Reserve and the US government, they have created the ultimate conditions for money to leave the system. Cash is either flowing into bonds to chase yield or away from retailers because everything is just too expensive. For the first time in modern history, money supply growth has gone negative. The M2 has hit minus 2.6% in the first quarter this year, which is a very bad omen. Where the money supply falls, less money is circulating around the economy. The banks, they start to lend less and consumer demand declines. Money supply is a leading indicator of the economy, and now it is at a historic low. It's a big warning signal, guys, that a crash is probably coming really soon. Now, if there's one reliable indicator of a recession, it is the yield curve. The more inverted it is, it tells us how frightened investors are today. And what do we have? The yield curve reapproaching the recent extreme inversion back in March this year. The spread between the 2-year and the 10-year yield is about to hit a full percentage point, 100 basis points. Traders on Wall Street, they are betting that the Fed is going to crush the US economy to a recession, so they are buying longer-term bonds to lock in their returns today. In a Bloomberg survey, a crazy 61% of people said higher interest rates will spark a recession in 2024. They will still see more rate hikes and no cuts until 2024. So even though the stock market is rallying right now, this probably won't last for much longer. It's all about the AI hype train, but reality is going to hit sooner or later. If I had to bet on a soft landing or a recession, my money, guys, will be on a hard landing. I really believe that a recession is unavoidable. I don't think it will be a horrific crash, 50% down, 80% down. No, I don't think so, because the US government can always keep deficit spending up. But in the real economy, a big contraction is likely coming. So hang tight, guys, because we haven't even seen the doom and gloom yet. We are still in Teletubby land. So let me know what you think in the comments below. Is a US recession guaranteed? Will it hit us this year or in 2024? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.